Sometimes you make decisions for all the right reasons, but don't always fully play it out. And what I mean by that is, what if it all doesn't work out exactly right? What are the potential consequences? And in retirement, there could be some dire consequences that you may not be aware of. In this video, I want to help you understand 7 of the big retirement money traps I've seen people make and how you can avoid them. But before we get there, subscribe to our channel. I have over 30 years in this business and I want to share with you my experience and the conversations we have with our clients. So this topic is a little bit touchy. And what I mean by that is, what we often want to do in retirement is to be there for our family and to do things that will help them pursue their lives without trying to impact ours. But sometimes it's very difficult to find that balance, and sometimes you make a decision that could potentially be irrevocable that if it doesn't work out exactly right, could be very harmful for you. So I want to help you to avoid these 7 big money traps. So the first one is what I call co-signing. And this is a perfect example of where we want to help our kids out or our grandkids to move forward, and we sign off on that note knowing full well they'll be able to pay for it or do whatever it is they say they're going to do. It doesn't always happen that way. Let me give you a couple of scenarios. One you may never have been aware of, and it's with regards to signing off on college loans for your grandkids. Now, we'd like to think that all of our grandkids, once they go to college, will get through, and typically it takes, let's say, about 4.5 years. But some don't make it all the way through. And some walk out never having a degree, but having the loan. And some end up with a degree and a huge loan. And what if they are unable or not in a position to be able to pay off that loan, and that loan goes into default? You are the co-signer. And if you're collecting Social Security and you've co-signed on that federal debt, then Social Security will be able to garnish some of the income you are getting, impacting your cash flow. Another scenario is if you put your signature on the line with them, let's say for a car loan. I'll give you a perfect example. It was me. So I signed off for my daughter on a car loan. I even gave her the money to pay the car loan and had it put in the credit union so she could pay it on a monthly basis, improving her credit score. She didn't end up filling out the proper paperwork, and along the lines, she missed a payment. It impacted my credit score. Sometimes the good deed does not go unpunished. You don't know how it works out. If you co-signed for the house or the car and they go into default or something happens that takes down their income, you may end up owning that house or that car. So be very careful what you sign for. The number 2 big mistake I find is in regards to life insurance. And it's interesting, while you were working, there was a particular reason to own life insurance. If I pass on unexpectedly and I have obligations for my spouse or my kids to get through college, whatever it is, we want to make sure they're covered and they have the liquidity to get there. Once we retire, from my perspective, there's only 2 reasons to own life insurance. One, if you have a pension and if you pass and your spouse ends up not getting enough to allow for him or her to pursue his or her life, life insurance is a potential remedy. The second reason to have it is if your estate is so large you're going to have an estate death tax, life insurance might be a way to make your estate whole again. Other than that, I don't believe there's a lot of reasons to own life insurance on your own life, but a lot of people do. So what do you do with it? Well, you need to make sure you just don't surrender the policy or let it lapse. What you should be doing, along with your financial planner, is go and reach out to your insurance carrier and ask for an in-force illustration. Find out what the deal is, if there's cash flow on it, if you have to pay on it or you don't have to pay anymore. Get the details on it to find out the best way to maximize that line item for you, because I don't want you giving up on money that is yours because you've made the wrong decision for that life insurance policy. The third big mistake that I find, and we'll call it the castle. So the family home. You've been there for 30, 40, 50 years. The kids were brought up there. The grandkids have been coming there, but you're in a position where, it's maybe a little bit too big for you, or it's too costly now. And you find yourself in that very difficult position of having to make a decision monetarily for something that is attached with so much emotion. That house may be worth a lot, but you may be house poor. And I don't want you to make that decision that could take you down to stay with this house because it has all these memories associated with it, yet it takes you down financially. Be careful with this one. And this leads right into the fourth mistake, which I'll call the cottage, not the castle. And it's the second home. It's that place that you may have inherited from a previous generation. It may be intergenerational. You've had the opportunity for the family to be there for 50 or 100 years or even more. And again, there's an emotional attachment to it, but there's also a financial liability or responsibility to it that you really need to be aware of. This is something you need to take into account. The cash flow responsibilities, depending upon where the cottage is, it may not be in your state of residence. There may be an estate planning issue as well in terms of probate. You need to be very, very careful that you don't carry a financial burden for keeping the cottage's legacy alive, because there's also an emotional attachment here. And again, doing the right thing. Who are you doing the right thing for? You, the family, previous members? It's a balancing act. Go back to your financial planning team and find out what's the best decision for you. So I've got 3 more mistakes. I got one of these that I think is one of the big ones. But before we get there, I want to ask you, are you truly prepared for retirement? In my latest book, Don't Outlive Your Money in Retirement, I created a 2-minute quiz. Go to our banner, fill it out, invest 2 minutes in yourself. I will very quickly score which one of the 3 retirement preparedness stages you are in. I will get you a free chapter of the book along with a couple of worksheets that will provide you with a little bit more clarity as to whether or not you're ready for this next chapter of life. The 5th mistake, and I have this conversation with my clients a lot, moving to be near the grandkids. Now, you and I both know if we have grandkids, we don't care about the kids anymore, right? We want to be with the grandkids. Well, the kids' lives may have taken them somewhere else, different region, different state, further away. And it's important to you to have more than just Zoom calls with them. You want to be with them physically. How do you do that? Be very careful, because in our zest to be with them or near them for a longer period of time than just maybe lunch, it could be very costly. I've seen this go both ways. I've got one particular client. They moved up to Vermont to be with their kids and grandkids. The kids ended up having to move elsewhere as a result of a work change. And my clients ended up in Vermont, now unable to go anywhere else. Their friends were back in Massachusetts. She was having a health issue. They were stuck. They had nowhere to go, and it was a very regrettable choice that they made. I have another client who moved to be near her grandkids in California, and it was one of the best decisions that she ever made. Be very careful, have open conversations with all involved, and be very cautious with the way you approach this, because it can have not just a financial impact on you, but a lifestyle impact as well if you end up being somewhere you don't want to be. The sixth one could be very costly to you, and it's with regards to the Medicare sign-up window. If you do not sign up in time and you miss this deadline, it could cost you on an annual basis. So make sure in talking to your financial advisor, in talking to your health professionals, that you know exactly when your Medicare enrollment is. And I suggest to you putting on your calendar 3 to 4 months in advance of the date that you are turning 65, that you address this and not let it slip by, because if you don't sign up in time, it could be costly. And here's the final one, I'll call it the whopper, if you will, where my child is asking me to invest in their business or a venture or a vision that they have. We know that in the world of small business, 4 out of 5 are out of business soon after they're open. What are the odds that they will actually succeed at the level that they intend? Not just that they make it to a point where they're surviving, but when they actually thrive and you're able to get back your money or whatever you were expecting for your investment. Now, this is a very difficult and personal decision. I recognize that. And sometimes we just want to be there for our kids and allow them to do whatever it is they wish to do. It's not an easy choice, but I'm here, like I talk to my clients, to talk to you. You need to take care of you first. The kids are second. So if they're asking for a chunk of change to help them pursue a business investment, be very, very cautious. Do not commit more than you need to in order for you to pursue your lives. I'll give you a particular story. In the complex that I'm in many years ago, there was an individual who opened up a delicatessen. His parents took out a second mortgage on the house in order for him to pursue his dream of having this business. Unfortunately, the business did not succeed. It failed, and his parents ended up going into bankruptcy. So be very, very careful when it comes to this. I want to make sure you avoid these huge money traps in retirement.